Hi all, it's 25th September today. I'm going to touch on Lemonade, the insurance disruptor. So for this company, you just have to forget everything you know about insurance. It'll be interesting. Well, before I start, appreciate a like if you like this video. Do subscribe to the channel as well so that via the YouTube algorithm, more people will be aware of this channel where they can find a lot of stock analysis, broad market review, so that people can be kept updated on what's happening in the world. Well, what is this insurance disruptor? Basically, Lemonade is servicing a lot of parties, the homeowners, renters, pet, life, car, which is a new product. So it's a new way of thinking. Everything is going online and the platform, so AI can process your claims, which shorten the entire time frame to process a claim, which is a very plus point because people want fast free way of getting their claims back. A new product is the lemonade car, which I mentioned earlier. So you'll see that it's a new product that they'll be pushing out aggressively that can help in securing more customers, more premiums, which is critical for insurance company. So what's the Inforce premiums breakdown? The premiums that they collected for different products. So you see what I circled out. The renters represent 56%, homeowners 30%, pet 13%, and life 1%. As part of their risk management, they have ceded 75% of their premiums to reinsurance companies so that this will free up capital for their balance sheet. The good and bad, because if you see the recent 1Q2021 results, the natural disaster, the taxes freeze impact on the gross loss margin, but because of the reinsurance program, this actually mitigate the impact heavily, mitigate the impact that can hit the P&L. So there's a big loss, but the loss itself wouldn't be that big. So what's the strategies going forward? What they are saying is they are growing and retaining more of the in-force premiums from diversified product range. So by introducing more and more products along the line and with their in-house tech knowledge, the AI codes being even further fine-tuned, they'll be able to handle more and more products, and that in a way can enhance their claim processing and also reduce the gross loss ratio. They're also fine-tuning the premiums to be shared with the reinsurance companies so that instead of 75% which they are ceding to, they are going to actually seek even less percents going forward. It's a plus and bad point with, but they believe that given their in-house knowledge via the technology improvement, they can control their risk even better. So what they are doing is they are going to improve their product range, enhance their product range, and grow their customer base. So you see the enforced premiums, which given by them is the aggregate analyzed premiums for customers for the period. And so it actually grew by 91% to around 296 million USD as compared to 2Q 2020. This driven mainly by 48% increase in customers number and an increase in premium per customers by 29%. So by 2Q2021, customer count actually went up 48% year on year to 1.2 million. This number we have to monitor very carefully because if you want to grow your revenue, basically is how much premium they can collect from how many customers and what's the premium they are collecting from per customers. Well, the sad thing is if you actually look at the cost structure, operating cost is going up tremendously, 126% from 30.1 million USD in 2Q 2020 to 68.1 million USD in 2Q 2021. A huge part, close to 50%, actually went to sales and marketing, which they had mentioned is the advertising employee cost. This I can understand because you want to grow a business, you have to spend more marketing dollars. And it's not really super well known that they can save a lot of advertising costs. And also they are trying to come up with a new product, right? So they have to spend more advertising rev dollar. As a result, net loss of 55.6 million, which is a very big number compared to a profit in 2Q2022. The good point is that they actually did a fundraising, and the cash position is 1.2 billion out of a market cap of, well, 4.3 billion. So that's a positive sign. This is a snapshot of the operating expenses breakdown that they break down into sales and marketing, technology development, and general and administrative. So sales and marketing, the biggest cost of these operating expenses. But something that I do not like is, why do they not disclose the technology development and general and administrative expenses breakdown? It's weird, isn't it? So it seems like these numbers have grown tremendously, half of the cost, and it's growing to around 15 million each, which is like 15x, close to 15x, no, close to 7x of what they used to be. This is not very positive. So look at gross premium and the gross loss ratio, which is, and the net loss ratio. I don't like the figure of the net loss ratio going up to 80%. Gross loss ratio itself was 74%. That was like 7% higher than the 3 months 2020. Yeah, so you see, uh, a higher gross loss ratio with higher operating expenses led to higher net loss ratio. This also explains why you will know later when I'm going to show you the share price chart. The price came down after the 2Q results announcement. So this is the time series of the gross loss ratio and net loss ratio. Well, with higher net loss ratio, which was previously around 75, 74, 71%, now 80%, a 5, 6, 7, 8% jump. Look at the share price chart. Well, it have broken support of $109 when it was in the early part of the year. So it came and retest that level again in May, June 2021. But it can't, and it's thoroughly make a lower and lower high, and recently hitting $69 USD. So I'm concerned that if it continue to exhibit further pressure to the price, in the event that broad market shows certain weakness, it may go further down to 63 USD, and if you cannot find the support there, that it may even go down to as low as 44 USD, which it had hit before. To note is that the IPO price is at 29 USD, and analyst price target can range 26 to 130 USD. As you know, garbage in, garbage out for valuation models, so you have to take with a pinch of salt all this price target. So for me, I will take a step back, not invest in this counter, and wait for the Q3 results to reassess the position and see whether Q3 results can reverse the downtrend. As always, this should not be construed as any investment or trading advice, because this reflects my thought process for my own portfolio. But hopefully, through going through the numbers and the business model, people can have an idea how that business model is revolutionizing the insurance industry by using AI to process claims and process the business. All right, thank you. Appreciate a like for this video and subscribe to the channel. Thank you.